Let's be real. If you want to build actual wealth, your money can't just sit there. It has to go to work for you. And today, we're talking about the tool that lets you do exactly that, the brokerage account. So let's dive right in.
So let me ask you a question. Right now, is a big chunk of your cash just parked in a savings account, earning practically nothing in interest? Look, that's safe, and that's not a bad thing, but it's not really growing, is it? In fact, it's probably losing value to inflation every single day. If you want to get ahead, you have to put your money to work. And that, my friends, is where investing comes in.
So, what's the key to this whole world of investing? Well, for most of us, it's something called a brokerage account. You can really think of it as your personal gateway to the entire financial market. At its heart, it's really just the special type of account that acts as a container for all your investments. I like to think of it as a shopping cart for the financial world. You put cash in it, and then you use that cash to buy, sell, and hold all sorts of things. Stocks in your favorite companies, bonds, mutual funds, you name it.
And this is where the amazing freedom of a brokerage account really shines. Unlike retirement accounts, which you've probably heard of, there are basically no strings attached. There are no limits on how much money you can put in, no penalties if you need to take money out early, and it doesn't matter how much you earn. Anyone can open one. It's an incredibly flexible tool you can use for pretty much any financial goal.
Now, all that flexibility brings us to a super important comparison. It's really easy to get brokerage accounts and retirement accounts, like an IRA, confused. They can hold the exact same investments, but their rules, their purpose, and especially how they're taxed are worlds apart. We need to break this down. Okay, so look at this. The big trade-off is flexibility versus taxes. On one side, you've got the IRA, which is built specifically for retirement. It gives you these amazing tax advantages to help your money grow. But, see the catches? There are limits on how much you can contribute, and big penalties if you try to take money out before you're 59 and a half. The brokerage account is the complete opposite. Total freedom. Put in what you want, take out what you want, whenever you want. The catch? You pay taxes on your investment gains and dividends every single year.
All right, so once you're ready to open an account, you're going to hit your first major fork in the road. You have to choose, do you want a cash account or a margin account? And believe me, this is a critical decision, especially if you're just starting out, because it totally changes the rules of the game.
A cash account is, well, it's exactly what it sounds like. You can only invest the cash you actually have in the account. Simple, straightforward, lower risk. You literally can't lose more money than you put in. A margin account, though, that's a different beast entirely. It lets you borrow money from your broker to buy more stuff than you could with your cash alone. This is called leverage, and it is a serious double-edged sword.
And let me be crystal clear about this. Using borrowed money, using leverage, can absolutely amplify your wins. But it will, with the exact same power, amplify your losses. With margin, it is entirely possible to lose more money than you ever put into the account in the first place. That's why, for pretty much every beginner out there, a simple cash account is absolutely the right way to start.
Okay, so you know what a brokerage account is, you know what type you want to open, so the next logical question is, where do you go? This is all about picking a brokerage firm, and let me tell you, there are a ton of options out there.
Choosing a broker isn't just about finding the one with the flashiest app or the lowest fees. You really want to look at the whole picture. Yeah, you should definitely consider the fees, but you also have to ask, is their website or app actually easy to use? Do they give you good research and tools to help you learn? And this is a big one. Can you actually talk to a human being if something goes wrong?
Just to give you a quick lay of the land, here are a few of the big names and what people tend to say about them. Fidelity often gets top marks as a great all-around choice, especially for people just starting out. Charles Schwab is famous for its in-depth research and top-notch customer service. And then you have platforms like Webull that have really leaned into the mobile trading experience. The best one really just depends on what you're looking for.
So this brings up a question I hear all the time. You see all these ads, right? Zero commissions, trade stocks for free, which makes you wonder, how on earth are these companies making any money? Are they running a charity? Well, it's a great question, and the answer is a definite, resounding no.
It's not magic, it's just a different business model now. A huge chunk of their money comes from the interest they charge people who borrow on margin. They also get paid for something called payment for order flow. It sounds complicated, but all that means is they get paid a tiny fraction of a penny to send your trade to a big market-making firm. Throw in some money from premium subscriptions and other account fees, and you can see how it all starts to add up.
Okay, let's talk about something that's on everyone's mind. Safety. You're putting your hard-earned money into this thing. You need to know it's protected. So what happens if your brokerage firm goes bankrupt? Is all your money just gone? It's a scary thought, but thankfully, there are some serious protections in place. The key organization you need to know about here is the Securities Investor Protection Corporation, or SIPC for short. It's a nonprofit that was set up by Congress. And what it does is, if your brokerage is a member and it fails, SIPC steps in to protect the stocks, bonds, and cash in your account for up to $500,000 total. That includes a $250,000 limit just for the cash sitting in your account.
Now, this right here is the single most important thing to understand about this protection. SIPC is not insurance against making a bad investment. It does not protect you from market losses. So if you buy a stock and the price tanks, that's on you. SIPC only protects you if the brokerage firm fails and your assets go missing, not if their value just goes down. It's a huge difference.
One last quick point on protection, and this is about the advice you might get. You need to know that not all financial pros are held to the same standard. See, a fiduciary has a legal duty to act in your absolute best interest, period. But someone else might operate under a lower suitability standard. That just means their recommendation has to be suitable for you, even if it's not the absolute best option, and maybe even pays them a higher commission. The takeaway? Always ask the person you're talking to this one simple question: are you a fiduciary? Their answer tells you everything you need to know. So, as we wrap this all up, what's the big idea here? It's that the best broker isn't the one that's ranked #1 in some magazine. It's the one that's the right fit for you. It's all about matching their platform, their tools, and their fees to your specific goals, your budget, and the way you want to learn about investing.
Look, the whole world of investing can seem a little intimidating from the outside. I get it. But opening that first brokerage account is your ticket in. Now you have the knowledge to start making smart choices for your own financial future. The only question left is, what's your first move?